Year to date, the S&P 500 has performed very strong right across the board, and when we actually take particular focus onto the real estate investment industry, we actually see nearly double-digit growth for every single company that sits within this sector. And we just heard not too long ago that 50 basis points interest rates would be what the Fed would be cutting for, as we can see, the first time in 4 years. And JP Morgan have gone one step further and said they believe it will be likely that we will see 2 additional rate cuts in 2024, with more cuts coming into 2025. Now, why we highlight this piece of information? Because when we take a look at history, we can see the total returns after the first rate cut has been fairly strong for REITs, in particular against other sectors. In fact, the S&P 500 at negative 0.5% has underperformed the REITs of 1.6%. We do also note here 2 other sectors that have performed very well, and another image that we do like to show on this channel is that ultimately over both the next quarter as well as the subsequent 4, REITs, which are highlighted in the dark blue, tend to outperform the equity market as a whole. Now, why we bring this to your attention is because in today's episode, we are focusing on VICI Properties. It is a REIT that we do hold. In fact, one we have been accumulating when it was sitting towards its 52-week lows. And you can go check out our videos where we were mentioning that we did see it as significantly undervalued. Now, today we want to understand, is this a buy now? We do get a strong buy signal from Quant and a double buy from Seeking Alpha and Wall Street. And we're also going to look at their metrics, understand whether or not the dividend, which has seen some nice growth over the last few years, in fact higher than the 4% we got just this month, is one that we should seriously consider to add more for the future, as we can see REITs tend to outperform. Now, we're just going to take a very brief look at their latest investor presentation, and this was released in the beginning of September, so only a few weeks ago. And for those that don't understand, this company effectively is a REIT, which is a real estate investment trust, and they effectively have 13 tenants. Pretty much we will take a look at their geographical location, but the majority of them are in Las Vegas. In fact, 18 of these properties are held by Caesars Entertainment. We have 13 from MGM Resorts, and you could pretty much wrap these 2 up and say they are the bulk of where their annualized cash comes from. Ultimately, that does make up, as we can clearly see, 74%. So you do have to be fairly bullish on Las Vegas as a whole if this is a company you are considering. And a few things that we do like about this company. First thing to note, there are high barriers to entry. What this ultimately means is that it's very difficult for a new company to come in and take away a lot of the business that we can see VICI have been operating. And one very strong sign is that during COVID, so 2020, where a lot of these places were ultimately in lockdown, shut down, no consumers could go, they still managed to get 100% of that rent collection. So a very good sign if indeed we see something similar to a repeat of 2020. And when you look in comparison, we can in fact see it was 70 to 99% for other REITs. And the other thing that we've just skipped by here is the remaining lease on average for the majority of their tenants is around 41 years. So it has locked them in for quite a significant time, and you probably could convince yourself that this will be renewed when the lease term ends. The other thing that we like about this company, we will look at this in more detail, that they have been growing their dividends over the long term at a very nice rate of 7%. Bear in mind the starting yield also looks very attractive, which we will cover shortly. And then you do compare it to other REITs, for example, a very large favorite in the community of Realty Income, that's around 3%. As we just mentioned, VICI does look good at the 7% level. We also want to highlight the geographical locations. Whilst the majority of their properties are in Las Vegas, we can see right across the US there are a number of other locations, and we can also see it in Canada as well. The other thing that we like is the diversification through the revenue streams. It's not just hotel rooms, there's a lot of gaming spaces, meeting conventions, food and beverage outlets, as well as some golf courses, and notably recently as well there was a bowling complex, which we did cover a few months ago. Finally then, one thing that we have already mentioned, you do need to be bullish on Las Vegas as a whole, and there have been some notable events that have taken place, as well as we can see here, some that will take place in the future. Lots of positives that we do see with this moving forwards as well, and recently also had the Sphere. Now, going back to the actual company itself, VICI Properties, as we said, pretty much a triple buy rating across the board. it does sit towards the mid to upper end of the 52-week range. A yield, now this is paid quarterly at 5.23%, a P to FFO of 12.7, and as we can see, over the last year, it is up around 8%. Over the last 5 years, up around 44. Now, that is a decent return, and we will also shortly compare it to others in the industry. Now, looking at their metrics, we get a 50 borderline safe score for the dividend. Now, we will come to understand whether or not we have anything to worry. As we said, attractive yield, and we'll also take a quick look at this new valuation model. And just not too long ago, this month, they did increase that dividend at 4.2%. If you're a regular on this channel, we do like to see at a bare minimum 4 just to keep up in line with inflation. Now, their safety score was reaffirmed a few weeks ago, and what a borderline score ultimately means is that there is a moderate risk of a dividend cut over a full economic cycle. Now, as we said, in line with inflation this month, but also nice to report over the last 5 years, they have on average increased the dividend by around 10%, not something you typically see for the industry, so that is a good positive for VICI Properties, and they have been increasing those dividends for the last 5 years consecutively. Now, in terms of looking at the 5-year average P to AFFO, the adjusted funds from operation, we can see a reasonable valuation signal. And ultimately, when we look at the last year, what this tells us, in fact, for some of this year, it has been trading below the fair value, which is effectively the blue tunnel. Right now, according to this model, it sits right in the middle point, which is why they have that reasonable valuation signal. But we will conclude on the valuation when we run it through our own model shortly. We also do like to look at dividend yield theory. Now, this states a company is undervalued when the current yield sits above the 5-year average. Given this is marginal, you could say reasonable valuation / slight undervaluation. Same to be said for the forward P to FFO, marginally lower than the 5-year rolling of 14.8, but we do note it does sit lower than real estate sector as a whole at 17.7. Now, bear in mind, we don't jump to any conclusions solely on these models, and we will get to our own valuation at the end of the episode. Now, adjusted FFO payout, we want to see below 75% for hotel REITs, pretty much what we see year on year, and this is one of management's targets. They do want it around the 75% point, which we can see they hit in 2023, expected over the next 12 months as well, so always a good sign. Ideally, you do want it as low as possible to give you faith they can continue to increase it at a favourable rate to shareholders. AFFO as well, similar to when we do look at companies with free cash flow. The reason why we're not looking for VICI, it is a lot more volatile. We want to see consistent increases over the longer term. Something we see, although a little bit inconsistent, nice to report over the next 12 months, they are expecting growth as well. And if you do want to see it from a percentage point, we can see, in fact, over the last 4 years, 3 of them have been double digit. We do notice a slowdown expected of 3% over the next 12 months. Now, for REITs, 5 to 10% growth year on year, which is very nice to note from 2020, but at the same time, as we will come to look at their shares outstanding, you don't want them to dilute your position at a massive rate. And one thing we have to highlight with VICI Properties, similar to when we review Realty Income, this company does unfortunately dilute your position fairly rapid. In terms of the dilution process itself, it is something that we see a lot with REITs in the industry, as they don't retain a lot of that internally generated cash flow after paying out the majority as dividends. We also note some nice strong growth if you do want to see it from a numerical perspective, 900 million in 2018 to 3.61 billion in 2023. ROIC, as always, 10% or more for typical companies, 3 to 5 for REITs. Give us the faith management, or VICI Properties management in this case, are able to effectively allocate their capital. Looking very strong, in fact, between 5 to 8% over the last few years. So we do quite like this. One of the reasons we are invested in this company, they do have a lot of strong metrics. Margins also looking very good, as we can see, even though it is inconsistent, still very high for this industry, 93% on a trailing 12-month basis. And the final metric, which is one of the reasons, if not the main reason, why we see that borderline safe score, the net debt to EBITDA, referring to the earnings before the interest, tax, depreciation, amortization. Now, this ultimately correlates to both dividend safety, balance sheet strength, and we want to see below 3.5 for hotel REITs, as we can see pretty much above that every single year. 5.86 in 2023. Nice to report, it did come down from the highs of 6.46 in the previous year, and is expected to continue to come down, 5.44 the target over the next 12 months. Now, something that I would say just to keep an eye on, but bear in mind this industry as a whole do have very high debt levels. It is one way that they can continue to increase in size, but as always, something that we will focus on when we do review these companies. Nice report though, based on this information, the decline that is noted, as well as the 75 AFFO payout, the dividend for now does look to be safe. Now, we also want to let you know, just today we have released our latest free weekly article. We drop one every single Monday morning, and we also include 3 stocks that you should take a look at, as well as a market update. If you want access to this or any others, you can grab a copy by clicking on the pinned comment below, sign up and read straight away, and you will also be able to grab our 25 undervalued stocks for the month of September for your consideration, where we also take a look at those that sit within our own portfolio. For this month as well, we have released, in fact, 22 dividend stocks with the most upside according to Wall Street. So don't forget, click below, sign up and read straight away. The other part of our analysis is also looking at insiders and institutional movement. Insider ownership 0.25%, and we don't really see any selling over the last 12 months. We see some buying, although very minimal at 87,000, and in fact in quarter 3 and quarter 2 we see no movement. Quarter 1, as we can see, that 87,000 buy, and whilst we do believe it to be a little bit outdated, we will show nonetheless that James Abrahamson, the director, on the 14th of March did buy around 3,000 shares at just under $29. Typically, we do like to see this insider buying bullish signal, as we believe insiders only buy because they see the share price going up, but as we said, a little bit outdated for the purposes of our analysis today. We also want to take a look at institutional ownership, very high, 98%. Whilst there's been around 2 billion worth of sales over the last year, we see nearly double the amount of buys during the same time period, and in both the more recent quarter as well as the last 4 quarters, we see institutions have been buying more shares than they've been selling. As a reminder though, never copy insiders or institutions or any investor, to be honest, and always do your own due diligence before executing. Now, whilst we've already reviewed the revenue, which as we can see from both a graphical perspective as well as a numerical basis, it has had some massive growth, we want to also take a look at the bottom line net income to understand if we can see a very similar top line, and in fact 43 million in 2017, 2.5 billion in their latest annual report. So a good sign that both top line and bottom line do move in the right direction, but always something key to review when you do analyze companies to ensure you don't have companies that increase very rapidly whilst not being able to show the same on the bottom line. A quick health check then, total cash versus total debt. We can see they had 0.4 in 2015 and around 347 million in their latest quarterly report. And in fact, their cash position has been very inconsistent on a year-on-year basis. As always, we do like to compare this to their total debt figure numerically and directionally. Otherwise, in isolation, it doesn't tell us anything. And in fact, we see whilst the cash very inconsistent, total debt has been climbing over the longer term. In fact, 4.8 billion in 2017, 17.6 in the latest quarter. Now, we already looked at the net debt to EBITDA. It does look very high, but is starting to come down. Always something just to keep an eye on. We do note that REITs take on more debt to increase their size. Always something to keep an eye on moving forwards, especially so it doesn't affect that ultimate dividend that investors do see. Now, what are their expectations moving forwards? In fact, for the next 4 quarters, they're anticipating 2 of them to be double-digit growth, with 2 of them to be negative. And when we look to their historical performance, they have a 50% track record. They've beaten analyst targets and management 2 out of the last 4 quarters, although most notably they did have a marginal beat of 5 cents. If they do then hit their full December 2025, the P to FFO will come down slightly to 12.23. Now, we do typically like to look at some gradings when we analyze companies on this channel. With REITs, it's a bit more difficult, but we will still show the process. They have a B+ on valuation. Now we really need to focus on the price to adjusted funds from operation, and as we can see at 14.66 on a forward-looking basis, this is trading lower than the sector of 17, which we did cover when we analysed the metrics. What this ultimately means is that if you are buying this company today, you are paying around a 14% discount to the sector as a whole. Whether or not it deserves that discount, this is a question we do ask ourselves and we do cover when we run through the valuation. Now, growth grade looks very good. They do get an A+ overall. A lot of this we have covered in terms of their dividend and their growth, but we can in fact see the adjusted funds from operation growth over both the last 5 years as well as in fact the last 3 years has been a lot better than the sector median. So very good in terms of the growth perspective, and profitability A+. So pretty much looking very good in terms of the quality of this company. It is high quality according to these ratings, and the main one that we would focus on here is ultimately their cash from operations, 2.29 billion, significantly higher than the 235 million that we see from the sector overall. Now, as a quick little conclusion for this part of the analysis, a double buy from Seeking Alpha and Wall Street, a strong buy from Quant, a B+ on valuation, an A+ on growth with an A+ on profitability. Now, the final thing we'll look at before we jump into the valuation is how have they performed against others in this industry. We have Iron Mountain, Gaming and Leisure Properties, as well as some very large others that are very well known in this sector. Now, over the last 12 months, up 14%. This includes reinvesting those dividends, total return, but we do see them right there towards the bottom. What we note overall, though, the sector has performed very well, which we covered at the beginning of the episode. A lot of these companies up very, very strongly. Now, when we look at the last 5 years, we see them towards the middle, around 93%, which is very impressive. So basically, if you had invested in this company 5 years ago, for example, $1,000, right now, if you have been reinvesting those dividends, you would be sitting at $2,000. So pretty much nearly a double, which is a good sign for any investment over the last 5 years. But remember, it doesn't mean it will be able to happen over the next 5 or 10 or 15. Could be a lot better. In fact, it could also be very poor. So let's jump into our valuation. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of just under $40. The way we got to this, we ran it through the 3 models. First model, multiples valuation with the P to FFO of some of the companies we already compared it with. We have the average P to FFO, that of VICI Properties, and we get our first undervaluation signal with the intrinsic value $37.23 above the market price of $33. Remember, we don't look at any one of these models in isolation. We then have the dividend discount model, average growth around 8% over the last few years, looking very strong, as we did say, one of the best in REITs in terms of that growth. Now, forward looking, we've gone very conservative at 4%, where we get our second undervaluation signal, intrinsic value $43.68 versus the market value of $33. We then have the discounted cash flow model, where we have the free cash flow year on year, average growth very high, but we've gone a lot lower to be more conservative, below management targets. With the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to equity value, divide by the shares outstanding, and as we can see here, our third and final undervaluation signal, intrinsic value $38.05, market value $33. So the intrinsic value in today's episode is just the average of these 3 models. And don't forget, you can grab a copy of this model by clicking on the pinned comment below, where you can run your own numbers, whether it's for VICI Properties or any others that you do desire. So margin of safety, as always, we start with 10% on this channel. We execute if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, in today's episode, we'll buy at $35.69, and then we keep going till it's near the current trading price. And pretty much today, if you are buying VICI Properties, we see a 15% MOS. Now, for those that believe that is still too high, at a 20% MOS, a buy at $31.72, at 25%, $29.74, and at 30% around $27.76. However, in today's episode, a 15% MOS. And as we saw earlier, we had Wall Street and Seeking Alpha give this a buy, Quant give this a strong buy, and right now we have a price target of $36.50 with 11% upside. As always, give us your thoughts. Is this one you are considering to add to the portfolio or adding more shares with a 15% MOS, 11% upside? If you enjoyed the episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter and come and join us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.